Welcome to Idea to IPO. My name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,365 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. These days, we're 100% online. We hold venture capital panels, legal workshops, networking events, and more. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this stage, I'm going to hand it off to Roger Royce, our distinguished moderator. Roger, take it away.
Okay, thanks, Rob, and thank you to Idea to IPO for hosting this event. I am your moderator. My name is Roger Royce. I'm a partner with the international law firm of Haynes & Boone, resident in the Palo Alto office. I generally work with startups, emerging growth, and venture capital. So before we get into today's panel and program, I do want to make a couple of announcements, a few housekeeping items. First of all, this is being recorded, so if there's anything you missed, anything you want to hear again, you can track down the recording either on the Idea to IPO YouTube site, or by the end of the day, it'll be on my personal YouTube site. Just find it, Roger Royce on YouTube. We got a couple upcoming webinars I want to let you know about. Rob, Idea to IPO, does this several times a week. I moderate pretty frequently. Looks like I got a full dance card over the next month. Next week, Tuesday, September 1, we're doing a presentation, not a panel, on international startups, issues for companies from outside the United States coming into Silicon Valley to do business. You won't want to miss that. It's all new content. On September 8th, we have another panel, latest innovations in IoT, venture capital panel on IoT. September 15, another venture capital panel, funding in the COVID era, and September 22nd, a presentation, not a panel, on successful exit strategies. So that will be coming up. Now, if you have questions during the presentation, go ahead and use your Q&A box. We're going to have 1 hour of panels. At the end of the hour, we're going to open it up to questions. We'll get you your Q&A, and we'll do that for the next half hour, and we'll have you finished by 1:30 p.m. Pacific time. Don't use the chat box, use the Q&A box. Use the chat box if there's something immediate that I should take a look at. So before we get rolling, before I introduce our panelists, I would like to know who's in the audience. So go ahead and take a look at the poll that I just started. Let me know who's there. Are you an entrepreneur? Are you an investor? Are you a service provider like me? Do you fancy yourself a technologist? Are you in academia? Are you in government? Go ahead and answer the poll. Usually for these panels, it's about half and half, investors and entrepreneurs. Presentations, it's almost all entrepreneurs. Wow, we have a lot of service providers this time around. I'm going to leave that open for a little bit. Okay, mostly entrepreneurs, it looks like. I'll leave it open for a little bit, and I'll share the poll results with you. So our panel should know that we've got about 40% entrepreneurs here, 20% service providers, 20% of the people here are technology people. We've got no government, we've got some educators, and we have one investor so far. So it's going to be mostly entrepreneurs today. We've only got about half the people voted, so I'll leave that open. So the panel today is on InsurTech or insurance tech, and our panel of venture capitalists is going to discuss investment in InsurTech, startups, latest innovations in insurance tech. We're going to touch on the global economic and health crisis and how insurance tech can help offer solutions. So a lot of you might not have even known this was a thing, insurance tech. We're going to learn a lot today if that's you. Our panel, let me just introduce everybody briefly, then I'll give each of you an opportunity to describe who you are in a little more detail, and then we'll kind of launch into a discussion. Vivek Krishnamurthy is an investor with Commerce Ventures. We also have Ben Bergsma. He is with Munich Re Ventures, which is in, both of those are in the Bay Area, by the way, even though it sounds like it's someplace else. And Patrick Claus, he's with Moschmeyer Group, which is also in the San Francisco area. So we've got 3 San Francisco investors with names that might make you think they're someplace else. And again, I am your moderator. I'm Roger Royce with Haynes and Boone. All right, I will end the polling now. We've almost got everybody voted, and it looks like we've got about a third of the audience as investors, and a very technical group. In fact, see if I can share this. I'll share the results. All righty. So briefly, why don't you tell me a little bit more about who each of you are and how you come to this space, and then we can launch into something. And Vivek, why don't we start with you?
Sure. Roger and Rob, thank you both for having me again. This stuff is always super fun, and Patrick and Ben are really good friends, so even better to do this with folks you like and love. For those of you who I haven't had to meet before, or had the opportunity to meet before, my name is Vivek Krishnamurthy. I'm an investor with Commerce Ventures. We're an early stage pre-seed to Series B investor in enterprise software and infrastructure across financial services and insurance. We manage about $100 million across 3 funds and have invested in 70 companies to date. Some of those companies are folks like Bill.com and Marqeta and FinTech, but we're also in a number of InsurTech companies like Kin and Snapsheet and Mulberry and Cover and a number of others. I would say, to your point, Roger, insurance is probably, I think on a cohort basis, newer than a lot of the other kind of subcategories of financial services when we think about payments and banking and lending and stuff like that. But I think, and we'll speak a lot about this today. It's actually received probably the most amount of funding, despite being kind of the youngest on a kind of dollars in versus years, around. And so I think it's kind of, given birth to a bunch of unicorns, and is generally an interesting space. My kind of introduction to insurance came from kind of a misspent youth in investment banking many moons ago, but had the privilege of kind of being at FT Partners when we worked on companies like Automatic and Square Trade and Eliza, and so had kind of seen some of the more interesting trends in the space around large carriers and infrastructure providers willing to spend hundreds of millions, if not billions of dollars on critical infrastructure that enables them to distribute and serve their customers better. So having seen that venture outcome kind of early in my career, and chose to spend a bunch of my time here at Commerce on not just the fintech aspects of InsurTech, but core insurance infrastructure as well.
Okay, thanks very much. Patrick, tell us a little bit about yourself.
Yeah, absolutely. Hey, Patrick Claus. I'm an investor with Moschmeyer Group Ventures. Moschmeyer Group goes by MGV more commonly. MGV is located here in San Francisco. We write $250,000 seed plus and pre-seed checks into emerging spaces. We're industry agnostic, but our LP provider is a self-made billionaire out of Germany who made his billions in insurance and financial services. So usually around 50% of our portfolio ends up being focused on insurance and financial services. I started my investing career back in 2013, and just for reference, the term InsurTech was never put into Google until 2015. So back when we didn't have a term for it yet. By being a founding member of American Family Ventures, that was like a $50 million fund focused purely on kind of the evolution of insurance. Back then, there was only 3 areas we really looked at, which was IoT. It was called big data. Now it's called AI ML. And then it was insurance innovation. Lemonade was just about to launch. It was really early days. I ended up investing out of 3 different funds. It evolved from a small $50 million fund to a multi-LP fund of $200 million. In between there, I took a year off from investing and operated in InsurTech, focused on the SMB commercial space. So I have some operating experience. But most recently, I joined MGV in March, the first day of federal quarantine. I think that was like March 16th. So I've only been into the office once, but have written a couple checks over at MGV focused on insurance and fintech, but really excited to be part of this. So Rob and Roger, thanks so much. And thanks to all the attendees that are able to make it today.
Okay, thank you, Patrick. Ben, how about you? Can you tell us a little bit about yourself?
Sure. Save the best for last here. No, I'm kidding. So I'm an investor over at Munich Re Ventures. So Munich Re Ventures is a sort of a sole LP fund, corporate VC. Munich Re is one of the world's largest reinsurance companies, and so we are backed by Munich Re and a couple of their subsidiaries as well. We have a little over $650 million under management. We're a little bit more stage agnostic, so we write checks between seed and Series D, between $1 and $20 million. And also that's globally. So most of our portfolio is in North America and Europe, but we also have companies in the Middle East and Asia. So we look all over the world, although most of us are based in San Francisco. Personally, I've been in venture for about 5 years. I was a founder and operator of an unsuccessful startup once upon a time. Spent some time in finance as well. And yeah, my introduction to insurance was 2.5 years ago when I joined the Munich Re team. So I spent time at a couple of different venture firms and did not focus on insurance at all, but did love the idea of, I was really focused on legacy industries that were sort of ripe for disruption, although that term gets thrown around all the time. But and so when I kind of found Munich Re and met the team and the space, I just became enthusiastic about it. And our portfolio includes Hippo Insurance, Next Insurance. Those are two of the unicorns in the space. Augury, which is more of an IoT company. So we invest in sort of core InsurTech companies, but also other verticals that are sort of tangentially related to InsurTech. So yeah, that's me in Munich Re Ventures.
Okay, thanks very much, everybody. I'm going to share my screen for a little bit here so that everybody can see what I'm looking at, which should be a picture of some monthly deal activity insights. And you'll notice that there's actually a lot of money that goes into insurance tech. I wonder if before we jump into our panel, if we could talk a little bit about this slide. If I could ask my panelists to comment on, when you look at these numbers and these financing statistics, what kind of conclusions should we draw from this on the investment environment and investing in insurance tech? And Vivek, I think, whose slide was this? This is Ben's, right?
Well, it's not my slide. It's actually FTP, an investment bank focused on fintech here in the Bay Area. So this is their slide. But I think one thing to point out here is that monthly deal activity only goes back to July. So if you look down in the bottom left-hand corner of this, it just shows how InsurTech has sort of taken off. And Patrick's earlier comment around how wasn't really a thing till like even 2015. You can see this, and just both the deal volume and dollars invested. So, in the last 3 years alone, around $10 billion has been invested in the space. And we've seen a number of unicorns, some of which are highlighted on the bottom right side. So that's maybe just the one thing. I mean, this is a category that is attracting venture dollars and at a very high rate the last few years. And personally, I think, especially as we've seen other exits in the space, like Lemonade's IPO and Assurance's acquisition by Prudential, it's going to garner even more attention from institutional VC funds and entrepreneurs as well that are focused on the space. So, but I don't know if any of the other panelists have takeaways here.
Go ahead, Vivek.
So I think I kind of agree with Ben. Like the chart on the bottom left is hard to deny. I think we take a slightly nuanced view of that. What we think, if you kind of look at that top chart, you'll notice that for the most part, the deal count is flat to flattish. But when you look at 18 to 2019, you see the volumes are hugely different. And what that tells us is, yes, there's a bunch more venture dollars coming in, but for the most part, if you do the math, it probably means that there's a small number of companies, many of them, by the way, which are in Ben's portfolio, that are attracting a crazy amount of the dollars, right? So one part of it, I think there's a general consensus that venture capitalists are really excited about insurance. I think the flip side is when we think, we can get into this later, but when we think about the insurance companies that are most prominent, whether it's a Hippo or a Lemonade or an Oscar or a Clover, you see 4 companies that just alone past year raised $1 to $3 billion. Right, so it's, people are excited generally, but the flip side is not that every company being funded. You know, I think our emerging thesis is that you have these small number of captive players that are attracting a lot of this interest, and there'll be more to come in this category.
Sorry, Vivek, we're really not hearing you very well at all. Yeah, that might help.
I'll make one comment about this, which is, again, looking at the bottom left column, which is, you know, billions of dollars. So 2017, 2018, you saw $2 billion. And then in 2019, we saw $4 billion. Progressive, Geico, and State Farm, all names that I'm sure we're familiar with, in 2017 spent $2.5 billion alone on advertising. And so, yeah, these numbers are massive when we talk about $4 billion going into a space that many of us may have not even heard of yet. Or are just getting into, but they're still, the space is large. You know, the P&C, property and casualty, home and auto, $660 to $700 billion annually. So there's still a lot of upside to be gained here. There's still a lot of growth. There's still a lot of big deals, and then what drives that is ultimately we're still seeing a lot of new deals. We're still seeing a lot of seed deals come through the pipeline. So that's what really excites me about this space and this slide specifically.
So Patrick, let me pause on that for a minute. I'm going to stop sharing. So when you say this space, what is this space? Let's take a big step back and maybe define what InsurTech is for our audience and for me for that matter. What's included in this?
Yeah, I think I got a hard job here defining it. And I would say to the people watching, feel free to put in questions, whether you're an expert or this is the first time you've joined something about insurance. We'd love to hear your questions to make sure that we're not going too quickly or too slowly here. But insurance, InsurTech encompasses so many things. You know, back in 2014, 2015, one of our earliest InsurTech bets was investing in the Ring connected doorbell. And we absolutely classify that as an InsurTech investment in the IoT space because it protected people's homes. Over 90% of people that break into your home will knock on your door first, right? And so putting something on your front door to prevent theft was core insurance to us. And insurance, being a multi-trillion-dollar industry, touches so many aspects of your lives. It touches your financial security, your home, your car, your health, your life insurance, where you work, your work comp, your disability. And so InsurTech has its tentacles in many other industries. It's in IoT, it's in AI/ML, it's in fraud, it's in property tech, it's in real estate. So it's very hard to define what it is, but it's very easy to say what it touches, and it touches pretty much consumers' everyday life. And so ultimately, as investors, we make investments that are core insurance technology platforms, and Vivek has made multiple, so has been really good plays that are enterprise plays. But ultimately, we make investments on thing that touches the everyday Americans' lives and their financial security. And so when you look at it from that way, it includes fintech often. It includes how we bank. It includes how we make sure we make our payments and we operate our life safely. So I don't have I might have skirted away around it, but it's easier to say what it doesn't include. It often doesn't include biotech, but it includes so many spaces. It includes so many spaces. Then there's the core insurance.
I would add.
Yeah, go ahead.
I was going to say, Patrick, I think the way we tried to do this in a slide in an LP presentation, and we scrapped the slide for the very reason that you just mentioned. I think the way we were thinking about it is, you almost have to step back and define what is insurance. And insurance is really just a promise to pay, right? That promise to pay is hinged on, any number of things, right? It can be business interruption, it can be life, but there is a kind of an agreement between two parties where one person pays into a pool, and that pool agrees under a strict set of circumstances to remit money. That's really insurance. right? And when we think about insurance technology, it is any technology that helps that process, whether it is to get more people to pay into the pool, whether it is ways to manage that pool, whether it is ways to automate workflow. And I think really when you drill down to it at its very core, it is any type of application of infrastructure, software, or generally technology that makes that process more efficient or more expansive. And I think what's really fascinating that Patrick touched on is those technologies that contribute to making insurance better may or may not be just specific to insurance, right? So for instance, you think about like disbursement technology in financial services, the ability to remit money digitally without a paper check. That is clearly a financial technology application, but has a really unique insurance use case when it comes to dispersing claims. So in insurance, unlike a lot of other things that are like payment or lending or kind of siloed, it is in itself this kind of massive sub-industry that has been almost like falsely relegated into being just another vertical of fintech, when it is actually, I think in our opinion, is a lot more horizontal than that. And it kind of comes down to that core promise.
Ben, do you have anything to add to that definition?
I mean, no, I think that was spot on. The only thing I would add is sort of how we look at the industry. And one way that a lot of folks will break this down is there's like a challenger side and an enabler side of the industry. So what Vivek was saying, it's like there are companies that are selling into enterprises, selling into primary insurance carriers that are more on the enabler. We want to make your workflows more digitally native or more efficient, more secure, detect fraud. And then on the challenger side, there's these companies going head to head against existing, primary carriers, existing brokers, and trying to not necessarily replace them, but they're trying to take market share away from the Geicos of the world, right? And Root Insurance is a good example of that. And so that's sort of how we view this industry. And there's positives and negatives to kind of both sides of that.
An interesting way to divide it up. And looking at these numbers and it, especially on the prior slide, it seems like this as an investment sector is still strong, even here in 2020, given all that's happening. And I have to wonder, I know that there are some companies and industries that are doing better this year than they've done in past years. Amazon comes to mind. Have recent events, COVID, sheltering, protest, riots, unrest, have recent events been good for this as an investment sector or bad for this? Or have they changed the technologies? They changed the way you go about looking at companies and making investments? And I'll talk about valuations, stuff like that later, but just as a sector, does this make this a more attractive area right now because of the fact that we're living in a more dangerous world today? Anybody want to take that?
I can take a crack at it, and I would take a step back and look how insurance companies make money. I think if you ask Ben, Vivek, and myself, when we first got into this, how we thought insurance companies make money, we'd all say, well, they take your premium and then they deny your claim and then they save that money. And that's not true. The average top 10 insurance carriers in the US average 99.2 cents combined ratio. For every dollar that they take in of your money, they pay out 99 cents in operating costs and in losses. And so it's a pretty break-even industry. And so the industry makes its money on investing the float. And so when there's a global crisis like this, people are leaving their houses less, they're driving less. So for the first time, you'll see that a lot of the space is doing better. And you can see that in the way that they're giving back premiums because there are less accidents. People's houses are experiencing less fires because they aren't leaving their homes. There's less flooding, things like that. So yes, from that perspective, the industry is doing better. And then on the flip side, you have like SMB commercials, that's small to mid-sized commercial. People are struggling to pay their premiums or they're having huge losses. And so, yeah, the industry is a really mixed bag, but from a macroeconomic trend, insurance is the traditional markets don't really have a huge opportunity to invest and be operated in this space. And the insurance market has done better in economic downturns than most industries. And so from an investment standpoint, we're seeing the deal flow to continue to be strong because these insurance carriers making their money on the float, getting back to the original point, have a lot of cash on hand to operate and to make sure that their customers can be paid out. So we're seeing the industry from a venture standpoint to continue to be strong, in my opinion.
Patrick, that's really interesting, because I guess that's sort of counterintuitive. I mean, unfortunately, I live in California, where I'm looking around, I see fires, I see a crime wave, which is what we have here. Even in my little Menlo Park where I live, it's an honest to God crime wave going on. I see a lot of damage, and we haven't even come into the flooding and earthquake season yet. So it would seem to me that there's just lots of losses. But you make a good point. You're saying that most of these insurance companies, they make money on the investments, not on covering the losses. Would the rest
not
of
on denying the losses? They cover the losses by.
I'm sorry, not on denying. Okay, yeah, I get you. I'm guilty of that too. I've often said insurance companies were in the business of denying claims, not paying them. But you've challenged me on that, and I stand corrected and chastised. But getting back to your comment about where insurance companies do make money, I want to come back to something Ben said about challengers and enablers. Do we see technologies that maybe enable that a little bit better now because of what's going on? Maybe enable, and I know you say it's not fintech, but it sounds a lot like fintech to me now. Can you comment on that?
Yeah.
Go ahead.
I would say that, one of the things that is always funny is I think all InsurTech enablers talk about how the industry desperately needs to adopt change. Most of the things that carriers need to adopt have been around for like 15 years. So like digital disbursements, electronic premium payments, like these are not groundbreaking technologies that were only invented in the past 24 months. But what we have seen, right, and this is kind of the cleanest example, is like virtual claims estimation. But the notion of every person in a home has a smartphone. Why does someone need to come into your home and actually do all the measurements themselves and take a 3-4 hour period of time where they're inside your home, just kind of confirming that everything is what it is? We've seen in that category, digital acceptance has accelerated, mostly because carriers cannot send someone into your home. I think there's a question about the long-term viability and some very specific things about those businesses. But I think on the whole, what we're seeing, it's not like, until now, machine learning couldn't help a carrier underwrite better. But what we are seeing is because of certain physical constraints, we think that, carriers are going to be more open-minded to accelerating procurement, which is very unusual for a carrier or reinsurer. It normally takes, a really long time for them to adopt anything at scale, regardless of line.
Interesting. And what do you see that's actually, so that's on the enabler side. That's helping the insurance industry. What do you see as the big challengers? On the slide you put up earlier, it looked to me like there were some new models there that might be challenging. Just in general terms, what are some of the challenging technologies and challenging business models to the insurance industry that you might invest in particular?
Yeah, I think, there are a number of unicorns in the space that are just good examples of that. So the one that recently went public was Lemonade, which is in, mostly in the renter space. They just launched a pet insurance product. They also have some things for homeowners and condo owners. So if you take a step back and look at all of the really large lines of business in insurance, and especially in P&C insurance, you'll see a pretty large startup that's raised a bunch of capital. So Hippo Insurance, which is again part of our portfolio, they do home insurance, right? And it's a very different process than if you were to go to one of the incumbent carriers. And a good example, I won't name a carrier's name, but some carriers have like 90 questions, right, in order to get home insurance. What year was your house built? What type of roof do you have? Like it's a long process. It can take over an hour. Hippo utilizes third-party data to make that question list like 5 to 7 questions. They can get most of that data from other third-party data sources. So it's just a very sleek way to get the customer in the door and buying that policy. So in terms of auto insurance, there's a bunch of them. Metro Mile's been around a long time. Root Insurance is sort of the new kid on the block, but has raised a ton of money and is a unicorn. So those are the ones in my view where it's like, they started as maybe more of like an agent, which is called a digital MGA. And most of those are now transitioning to be full stack carriers. And there's positives and negatives to that, but which we can get into. But basically, they're going to say, hey, like Hippo may say, we're going to be the next State Farm for home insurance, right? And that's what we're going to compete directly head to head against them. So that's usually the one that everybody would think about when you say challenger. There are also, challengers on the broker side. So Newfront is challenging all the retail brokers, insurance brokers that are out there. So, yeah, that's what I would.
I was going to ask about that. As you said that, I was wondering if there's a lot of disintermediation going on in this, if it's just replacing brokers and lowering the cost. Is that part of the new models, because technology will allow you to just do that direct now?
I would say this, and I'll be brief and let the other panelists speak to this, but I think if you asked me when I first started in this, and even Jacqueline Lesage Krause, who started our fund 5 years ago, she would have said that brokers were going to be obsolete, right? Eventually, and maybe that may still happen, but we've seen quite a bit of stickiness in the broker model. I think, especially depending on the line of insurance, it's sort of still this relationship business, and so they have relationships with carriers and with their businesses and book of business, and so there is some level of disintermediation going on, but it's not near as kind of what you would expect, in my opinion.
You guys agree with that?
So yeah, I think I would 2 points. One, I've always thought that the challenger moniker put an unfair burden on a lot of like full stack startup competitors. And I think what I mean by that is, I don't think State Farm spends a lot of time worrying about losing revenue to Hippo, right? Just from a magnitude perspective today. They may down the road, but what Hippo has done that scares the heck out of everyone is they've completely redefined the customer standard, right? So State Farm may have more revenue today, but for them to go and acquire a Hippo customer or someone who thinks the experience should look like Hippo is now almost impossible, right? So they have a huge digital barrier. And so even with things like Newfront, right? I think a lot like Aon's fine, but the experience and the technologies that someone like a Newfront introduces as kind of, table stakes, it puts a really, really high kind of benchmark for a lot of these incumbents who haven't historically kind of invested in those technologies to come and meet. And I think that is something as a enterprise technology investor I get really excited about, right? Which is the more successful Hippo is, I think the more of a market they create for these technologies to help folks who have no chance of catching up ever to their workflow to have to do so. I would say, and Ben actually makes a really good point on the brokerages as well. I think particularly as like Silicon Valley VCs, I think we have this like penchant to try and automate the heck out of everything, just because we've seen it done in a variety of industries. And I think that we've seen this a little bit in other categories too, but the moniker we use around the office is like personal finance is personal, right? And if you think about a small business owner making a critical decision about their insurance policy, sometimes they're going to want to talk to someone. And I think, I think Ben said it well, I think in complicated lines like life and commercial and large commercial, it's really obvious that maybe it would still exist. But we've seen startups that offer kind of embedded, seamless home insurance, right? And this is the example I'm thinking about is Matic, for those of you who are familiar with them, kind of really phenomenal product that's embedded at the point of kind of click, if you will, within your mortgage servicer portal. And they still have people on phones, not because they couldn't do it without them. It's because the majority of customers, when they switch a home insurance policy, still want to talk to someone to figure out whether or not it's real. And I think that as much as it is possible to automate a lot of this, I think you'd actually have a lot of negative tailwinds for artificially automating certain lines that consumers still want that personal touch for.
Okay, interesting. Let me shift gears a little bit, and I'm going to maybe stick with, I guess you do, Vivek, you probably do more of the early stage stuff. I noticed that our panelists here, we've got kind of all over the map here, early to late. You got a fund funded by a family office, it sounds like, to corporate venture capital. So it sounds like, you know, insurance tech, well, two things. Number one, it sounds to me, looking at the panel, that it's very dispersed. It's like you say, it's very horizontal. But also it sounds like maybe it's, is it early days? Is it really decentralized and a lot of opportunities and just a lot of different companies attacking a lot of different problems? That's what I would guess based on what I've heard. So is,
Yeah.
we have, you know, 40% entrepreneurs here. They're looking for opportunities, and I know what they're all thinking. What's the problem that I can solve? What would you tell me?
Yeah. So I would say that I think it is early days for certain types of companies and later days for others. I'd say as an industry, still early days, and we're still very much excited about kind of finding the next large whatever. What I would say is that, you know, if you think about the past 2 or 3 years, it's actually been, you know, I would say even compared to any other category of fintech, InsurTech has dramatically outperformed with kind of post-IPO performance and exits, right? Whether it was SquareTrade or Assurance or SelectQuote, or now EverQuote stock is through the roof, or Goosehead. I mean, these are, you know, folks who, or even Lemonade, right? These are folks, enablers or challengers that have, on a relative basis, performed exceptionally well in public markets and, you know, been able to raise in the private markets. And so I think, you know, venture capital will follow liquidity and momentum. And today, insurance as a category has both, and on a relative basis, probably has the least experience compared to payments, which has been a venture category since like the 90s, and lending, which had its heyday with Lending Club and OnDeck, you know, 5-6 years ago. So I think you'll see a lot of attention. As for categories that are interesting, you know, again, you have challengers and you have a bunch of lines that have never been touched, right? You think something like long-term care insurance, which is, you know, huge category, unglamorous, maybe someone can build something there. I would say categorically within the functional groups of insurance, I think almost everything is still up for grabs, right? So whether it is next generation acquisition technology, kind of, you know, being able to compliantly change pricing and dynamically, being able to do attrition prevention, all the way to claims and claims disbursement and claim management to the core policy administration system. Pretty much every single main technology group that an insurance carrier uses, and I'd be curious to hear if Patrick or Ben disagrees, but I can't actually think of a single kind of venture-backed incumbent that has already categorically dominated the space, right? When I think of the largest players in InsurTech infrastructure, it's still Vertafore, Verisk. Like, these are not the most innovative companies. It's Guidewire. I think there's a lot of enterprise value to still be generated. So I'm really excited about kind of the road ahead for early stage insurance companies because of that.
I would say the thing that excites me most about entrepreneurs when they approach a space is you look at a lot of spaces that they're winner take all, whether that's cloud servicing, IoT, right? When you look at IoT, you're going to buy a Ring device, you're going to buy a Nest device, or you're going to buy an Alexa device. And their Wise is coming up, right? But it's pretty close to winner take all. And when you look at insurance, it is not a winner take all market, and I don't think it ever will be. If you look at commercial insurance, again, $660 billion space in premium. The largest stakeholder has, I think, 4.7% of the market in that line. And so taking 0.1% of that is a lot. And if you can do that more effectively and more efficiently, you can be a multi-billion-dollar company. And so that's one of the best appeals of this market. It's just, you can really win in this market effectively, and it's proven you can do it pretty quickly.
Ben, anything to add to that?
No, I think it was well said. You know, I feel like in terms of what I'm excited about right now in this industry is most of our effort has been put into, you know, for lack of a better term, I know Vivek doesn't like, but the challenger side, right? These companies that are competing with the existing value chain of insurance, right? And going head to head against it. And as Patrick just mentioned, it's massive. So, you know, if you can get a sliver of the market, you're still a very big company. But I think right now where I'm excited mostly and focused on is sort of on where Vivek spends most of his time, which is sort of the enablers or these companies that are focused on, you know, making incumbents better. And by the way, I think that there's going to be so many more companies and startups that are focused on the challenger side, that they're also going to be, they're building systems from the ground up. And so they're going to be more flexible to incorporate some type of, underwriting engine or, claims admin system. I think it's there's a lot of opportunity. We've also heard a lot of, anecdotal evidence, at least, where sales cycles are shortening for these companies that are selling into insurance companies. And so I think that area is, I think there's going to be some really big companies that play in certain niches of that side of the business, especially on the claims side. There's some good companies out there for sure. I think, but jury's still out on who's going to really be this sort of necessary solution to every insurance carrier that we need this from a claim standpoint. Maybe that's from a payments standpoint or some other aspect, but yeah, lots of areas on that side of the business that I'm excited about.
Well, let's talk a little bit more about that, especially the specific technologies that we see. So I do a lot of work with agriculture technology companies. One of the first companies that was big in the space, Climate Corp, you might remember, they used data and they were basically selling crop insurance. I mean, it was an inefficient, slow, uneconomic, terrible process, crop insurance, and they came along with data tracking weather patterns, and they could predict crop losses before they even happened, in effect, and they could pay out the farmers a lot sooner. Since then, I've worked with other companies that do things like, I see Jennifer's in the audience. I know she wants to know how she's going to use her drone. Well, here's how. Use it to fly it over the fields and measure those crop losses and report it back to the insurance company. That's several companies I saw doing that. So those are two technologies that have insurance applications. I did my research for today, went out and saw what other tech is out there, and I'd like to get your view on this. So the first thing that comes up when you research insurance tech is predictive analytics, kind of the Climate Corp stuff. How do y'all feel about that? Still opportunities in that? Is that still a big space? Is there still room to innovate when it comes to analytics?
Well, I would love to jump in with Climate Corp real quick and talk about the Climate Corp story, because before they were acquired by Monsanto for hundreds of millions of dollars for their crop insurance, their first evolution was actually business interruption insurance. They wanted business interruption insurance for surf shops on the East Coast for hurricanes, right? And they couldn't get it to work, so they actually pivoted, right? So when you talk about Climate Corp, I love the story from our space is that the evolution is still moving forward. And so that's kind of where I look. And when we look at our industry, and this week in particular, with hurricanes on the East Coast and fires on the West Coast, risk is not getting simpler, actually. We predict that risk is getting easier and easier to evaluate, but it's getting more and more complex. The future of mobility is still up in the air. Climate change is getting worse. And so I see that there's still tons of opportunity in just quantifying it and establishing risk well. It still often takes multiple weeks to get a quote on commercial insurance. There are 19,000 NAICS codes, and every insurance carrier underwrites them differently and has different capacity. There's still a lot of evolution to be done in the core spaces that we work in and how we quantify risk and distribute it. So, and I love how that fits into how Climate Corp, because I still see a lot of startups that look at that Climate Corp model of, I want to do business interruption insurance better. And I always then bring up the Climate Corp model. Why would this be different?
So how about predictive analytics? Are there still opportunities, or has the space been taken?
I would say, someone much smarter than me gave me this framework, but kind of his thinking was, carriers or insurance companies broadly, there are two types of data that are valuable, right? There's data that you always had access to, but you wanted quicker and cheaper and with better coverage. And then there's data you never knew you wanted, or maybe you did want, but there's no way to aggregate it. And I think maybe in the first category, you can say there's some level of saturation. I actually still think you can build, many large businesses providing kind of core data in non-obvious places. So I think of things like employment verification for life insurance, right? That's a data vendor that many people don't think about, but is pretty crucial for underwriting a number of policies. In the data category of people never knew they needed this, you can go look at kind of emerging success stories like the Carpe Datas of the world, right? Folks who are aggregating net new sources of data and providing them for the power kind of predictive analytics within carriers about fraud and things of that nature. So I think actually we're at the, like, forget the 99-yard line. I think we're at like the 10-yard line when it comes to actually harnessing this data, if that, right? Because there's the world of data, because there's two things, right? The carrier's willingness to underwrite on the data. And as we go more digital, there's more data that's actually able to be packaged and cleansed and normalized and used. And so I think as the sources of data continue to become more available, we're going to see a whole suite of more, fascinating predictive analytics outcomes based on carriers' ability to use that. But the natural friction point is your willingness to, re-architect your underwriting model for a new data set that you don't particularly trust. So I think the challenge in these spaces is when I think about kind of underwriting versus claims, the willingness of like actuaries to change how they underwrite in the different data sources is nowhere near the willingness of a claims group to try new tech to cut down on costs. So I think the market opportunity is probably a lot bigger with data businesses and predictive analytics. The two challenges is how can you kind of harness data and sell to a carrier without accidentally just becoming a data vendor. Those multiples aren't great and you'll be used as a commodity. And the second challenge is like, how can you actually survive these horrid sales cycles into folks who are not used to using outside vendors, particularly in this category?
Yeah, that's interesting. When you talk about data, you almost have to talk about artificial intelligence as next and using it. And PwC, they did a report here recently. They think that AI is going to improve efficiencies and automate customer-facing underwriting and claims processes. They think that's going to be big. Its impact will be profound because insurers can identify, assist, and underwrite emerging risks and identify new revenue sources. I guess find other things that could be insured. You all agree with that? The impact of AI?
Yeah. I would say, I think like Patrick does a better job explaining this because he's like just closer to it. But I am always astounded at the difference between where people think carriers are and where they actually are, right? And the anecdote I'll give is we are investors in KIN, which is a Florida coastal reciprocal exchange for insurance, for homeowners insurance. And when we were asking them how they built their underwriting models and used AI, they were like, oh, we use satellite imagery. And kind of our response when we were first doing diligence was, well, that can't be that special. And they came back with, most Florida carriers underwrite based on zip code. They cannot tell where your home is in relation to the water. Not tell whether you face the water. They cannot tell where the flood line ends. It's just like the difference between where you think they are and where they are. So I agree in that I think AI will make a big difference. I think consumers will continue to be disappointed with the end effect of that difference because I think the bar is so darn low. Even when they use kind of basic things, you're still below, again, where a hippo is. I think it'll take so long for a traditional incumbent home insurance carrier to even come close to that experience. The consumers are going to, those NPS scores aren't going to be great for State Farm for a while. But yes, I think AI will help them get out of the negative, at least in the near term.
Go ahead.
Yeah, I mean, I think the only thing I would add, I totally agree with that, what Vivek said. And I think it is like good to understand too, maybe for the entrepreneurs on the call, like it's like AI is it's going to be table stakes, right? For any carrier in like whether you're a startup or an incumbent carrier for a long time. The issue with the incumbents and these legacy carriers that have been around hundreds of years, in some instances, it's hard for them to recruit data scientists, right? I mean, if you're a data scientist and are you going to like join an upstart or a company that's raised some venture financing, or are you going to, join one of these insurance carriers? And it varies, but I think that it's a really good point, and it's an advantage that we've seen, even at Munich Re, right? And Munich Re has some fabulous data scientists and groups, but some of these upstarts think about things and the way they're able to manipulate and contextualize data is pretty outstanding. So I just wanted to bring up that point.
So related to data, social media data, and there's a Morgan Stanley report that was talking about how carriers are using social media to investigate claims, identify fraud. There's a Dutch company that actually uses social media for people to file claims and actually make applications. So there's another area where, you know, data interacting with social media. So well, let's move along. There's another thing that comes up, as I mentioned it earlier, is drone technology. You know, it's worth mentioning because the reports that I see call it out specifically, again, as a way of verifying claims. Is that an area that's ripe for investment for you guys, or is that something, I guess that's one of those enabling technologies. Have you seen much?
Yeah.
Go ahead.
I would say that, you know, it's weird. I think a couple of years ago, I don't know, guys, you saw, it was like everyone had drone tech, right? It was before Betterview had switched and a few others. I think we've seen this weird thing happen in aerial where there's so many new sources of data, right? You can get Street View for the home, you can get near maps, which will give you aerial data, you can get by kind of map risk, which will give you geospatial data. And so in a way, it's your drones were slightly ahead of their time and now kind of behind the time in certain lines. I think in really interesting use cases like commercial and construction, I think drones are still really, really, really interesting. I'd probably just spend less time there on balance. But when we think about like residential and commercial kind of property underwriting, I think most of the companies that we've seen actually don't use drone data, or if they do, it's through an outsourced party. It's kind of not their major source of gathering data. It's mostly some, you know, kind of low altitude aerial photos from planes, satellite imagery, and maybe some Street View. I don't know, Patrick or Ben, if you guys disagree or have seen.
No, I think I couldn't answer it. I think you did an excellent job. The only thing I would add in there is that insurance regulation is one of the barriers to entry in this space, and one of the most important aspects that we haven't brought up today. That insurance is not, most insurance is regulated by state, and it varies drastically. And when I was operating an InsurTech startup, I talked to the former California insurance regulator, and he told me this story that when all the regulators met, they always wanted to try to get the policy number in the same side of the piece of paper they sent out to the customers. And in 40 years, they can't come to a consensus on what side of the paper the policy number goes on. And so it's a hard space to invest in from my perspective, just because it is hinged so much by regulation, and there's tons of evolution of drone insurance will be important, but the regulatory aspect makes it quite difficult, and insurance regulation is a very, very scary thing for all of us, probably.
I think that's a good, like, I've heard this before, but basically it's not in insurance, it's not just product market fit, it's product market regulatory fit. So it's a good way to think about it, and yeah, it's a good point, Patrick.
Interesting. I wouldn't have thought of that. I bet it does make a big difference in how you can invest. Well, let me ask a couple of general questions, since I got a panel of investors, VCs. These days, you know, it's hard to have face-to-face meetings. And I saw the data that on the slide, the financial technology partner slide, but just anecdotally and personally, how is this affecting you? Are you making investments now? Are you taking meetings? Are you doing Zoom calls? I've heard stories about VCs making investments in companies where they never met the founders because it was all over, you know, Zoom or online platforms. Are you guys doing the same thing? And I'd like to hear from you two, actually, because you're all at different stages of the market. Sorry, go ahead.
So I think venture capitalists often get too much credit, generally, as a matter of fact. But what I mean by that is, I think VCs have touted for many years about the importance of meeting teams and getting to know them. And I suspect probably actually at our stage and Patrick's stage, which is super early at times, that is quite important. But what the kind of second half of that sentence is, the reason it's important to meet them is because other people are, right? And what I mean by that is, it is unacceptable for you to be the only VC who did not meet a founder in person, but in a unique kind of world environment where nobody is meeting anyone, as long as there's no, you know, asymmetry of information access, and you're seeing, hey, the lead investor is still investing and the co-investor is still investing, you can feel comfortable to make that transaction via Zoom. So we've done, I think we're at 7 or 8 investments, which is actually ahead of pace relative to last year. I think we're seeing really interesting kind of a lot of founders are using this time to think and brainstorm. And, this is probably one of the richer, environments for funding, not just in InsurTech, but in FinTech that I've seen probably in the past 2 or 3 years, with kind of one maybe exception. So we haven't seen a slowdown at all. And I think as a non-lead investor, we've always done, been comfortable doing this. It's not a preference, but it's something we've done kind of purely via Zoom or video chat. So not that different for us. But I suspect as you go up, it's harder to trust someone with $30 million when you haven't shaken their hand. So
going up with Vivek say, when I talk to entrepreneurs, one of the questions are you guys still writing checks in COVID? And my response though is, don't ask me yes or no. Ask me how many checks have you written in COVID to get a sense of kind of how that relates to our portfolio size versus that time horizon. And I think we were all kind of on or above pace. This is such a thesis-driven space, and so when you find a founder that has a core thesis that you believe in, it clicks pretty quickly. And so I think I'm the earliest, and then it's Vivek, and then Ben has been writing a lot of great late stage checks, but the late stage checks are still really thesis driven on the evolution of the space. And so your ability to articulate that thesis well, it really is more important than meeting face to face.
Yeah, for me, we wanted to do 8 to 10 new deals this year. We're at 7, so also on pace. And two of those we closed a bunch in Q1 that had kind of pushed from 2019, but 2 of them have been fully, or 3 now have been fully remote, where we've just done it over Zoom. They sort of tend to be, all 3 are on the earlier side. So one's a seed, the other 2 are Series A. And so it's not as big of checks, right? We're not, I think, we just have it, we pass on a number of later stage deals. We're still doing our pro rata in our existing portfolio, but I think, in terms of not meeting founders in person, the one thing that we've been doing is trying to do more reference calls. So we're trying to get to know these founders. We're spending a lot of time with the founders on Zoom and on calls, and but we also want to see like how they work, what's their working styles, what are people that they've worked with in the past, get their picture of them as well. So that's how we've been trying to diligence in this environment, and I feel like it's actually been pretty positive. So it's surprising the type of relationship you can still form even over just a video call. So yeah.
So briefly, last question: what's the rest of 2020 going to look like? What's the funding environment going to be like for insurance tech? Be strong, optimistic, pessimistic? Anybody? Vivek, we'll start with you. Sorry, Ben, we'll start with you.
I can go and then be told I'm wrong here by Vivek and Patrick. But basically, I think that on the backs of, it's not just Lemonade's IPO, right? Duck Creek had a really had a strong IPO. There's been some others as well. I think all of the later stage firms that have showed some that have already raised a good chunk of money, they're gonna build up their war chest. Many of them are gonna transition to full stack carriers, and so they want that balance sheet. So they're gonna continue to raise rounds of financing, even if they don't necessarily need it right now. And then I think on the early stage side, my guess is deal volume and total dollars are gonna be about flat compared to 2019, which we saw on the slide earlier, which was around just over $4 billion. But yeah, that's my guess. I'm hoping that there'll be plenty of founders that get funded at the early stages and in InsurTech. I'm very bullish on the space.
Yeah, I would. Unsurprisingly, Ben, I have a slightly different view. But it is less because I view the future of InsurTech and those fundamentals more differently than you do. I think it's more because I'm extremely bearish about the macroeconomic environment that we're in, between the inability to pass a new economic stimulus bill in a way that's not kind of painfully inflation punitive to folks. So I think I found that public markets are just as an anecdote, right? The first two companies that I worked with in banking were Green Sky and Prosper. I think both now their market caps are below their total amount of dollars raised. But what I found is that public markets tend to be very optimistic, but also very impatient. And capital will flee kind of yield generating stocks the second that things look very unstable. Lemonade is already below IPO price, which, to be fair, is still 3 or 4 times the last funded round. But, my concern would be, or what my concern is that by November or December, if the market hits a new floor, which I suspect it may. That being said, I've been wrong at every point over the past 5 years about what the public markets will be doing. But if that were to pan out, I think some of the publicly traded stocks in insurance will suffer first because they're trading at multiples that are 20, 30 times that of a Progressive or a Guidewire or something like that. And as those slow down, I think the incentive to be overly, bullish on early stage insurance will also go down. But I think over the longer course of history, I think it is unmistakably true that this industry will adopt new technologies. So I think, I actually think it presents an opportunities for investors, selfishly, where I think a lot of these technologies are a when, not if. Right. I strongly believe, Roger, to your earlier point, that social media data will, and if it can be harnessed compliantly, will be a bedrock of how claims fraud is determined. Right. I think I'm actually going to be in a better position to get into one of those companies at an affordable price in that market than I am right now. So I think as an investor, I'm more optimistic, but I think the market and funding patterns and a lot of this exuberance driven off of like public company performance will, rise and fall in tandem with the stock market, which I think is, if you look at PE ratios, the most volatile it's been since kind of for 30, 40 years. So we'll see. Patrick,
you get the last word.
Yeah, I'm super glad I get to go last because I think my opinion is right down the middle here. And my response is I agree with Ben's response and I agree with Vivek's response, but I have a different conclusion on it, which is insurance companies make their money by holding cash and investing that cash. And if we have a bearish, really bad market, which I think we all agree is likely to happen, I think there will be an acquisition race. I think that there's a question that we can get to about technology providers, but like some of the best technology insurance providers don't sell technology insurance. Like you look at Root, Clearcomer, and Hippo, they probably have some of the best technology stack available on the market and they don't sell it, they built it. And so I think if there's an awful downturn, there's going to be an acquisition rate. You can see how much cash each of the top 100 insurance carriers have like on any report, and they can afford to buy these companies and they will impact, these acquisitions will have core impacts to their software costs, which are billions of dollars. And so I think that acquisition race will only spur on new early stage investors. Entrepreneurs. And so I see it as a space that does better does better than the capital markets in bear markets. And so I see this space continuing to evolve and grow.
Okay, well, thank you for that. So, and for my part, I violently agree with all of you. All right, we're going to now open this up to questions. And if you have a question, make sure you type it in the Q&A box. Don't type it in the chat box. Q&A box if you have a question, and we're going to go through them. So first question, somebody would like you to comment on the top 3 enabler technologies that insurance companies are looking for help. So anyone, go ahead, Vivek.
I'll just say one, and it's only because I mentioned it like 5 times. I think one of the larger opportunities that when I broach the topic with a carrier, it's almost always like, hey, that's really interesting, is actually claims disbursements. So push payments that enable full check replacement in the disbursement of a claim that can be done via email. And the reason is it sits in this like very narrow sliver of technology that saves a lot of money. So a single check takes about $7 to cut, print, and mail. And there's competitors out there that can do it for 10 cents now. It's the most amount of money that can be saved with the least amount of integration. So it is actually not hard to get it up and running, and it is a pure cost ROI. So that's one. that I think I'm excited about, that I've heard positive things about.
That's one. Go ahead, Ben.
Yeah, well, I'll give one too, and then Patrick can be three. But I looked at this company. I'm a big fan of the company. We're not investors, and I think the other two guys here know them as well. But there's a company called Flyreel that is basically enabling remote home inspection. So in order to get, if you're in a high risk area or your home is just very old and hasn't been inspected for a long time, and you're trying to get home insurance, sometimes they'll send out somebody to look at the home, and it's part of the underwriting process. And so essentially Flyreel does that automatically just through your smartphone. So you go around and you can imagine right now, you don't necessarily want a stranger coming over to your house just so you can get a home insurance policy. So, it's a really interesting company. They use machine vision, and you go around the house yourself scanning things, and very, very cool company that I like. And I think that space in general is so relevant right now to enable, these digital workflows that historically have been by people being in an office or on site somewhere. And so I think that whole space is really interesting to me right now.
I'm going to give a slightly more nuanced answer, which is when the question was, enabler technologies, the answer is look at Guidewire's numbers. Guidewire is the largest insurance software provider, and they don't have that many customers, but they've never lost a customer in their lifespan of the company. No one has ever churned. And so when I think about what is a software technology provider that's B2B that never churns, that's the type of kind of hooks into the industry I would expect, but that's regulatory. I'm really like a company called Bold Penguin, which helps carriers and agents quote SMB commercial. So I really like Bold Penguin if you're looking at a business model. It's called the SIMC space, single integration multi-carrier interface. And then also I would expand on Vivek's comment about claims. That I have slides, and if everyone wants to talk about the claims space, but it has a lot of evolution, and there's a ton. Billions and billions and billions and billions of dollars, whether that's actually just claims payments or just software capabilities. There's so much room in claims.
You really got me thinking, a comment you made a little while ago about the regulatory aspect of this. Have you seen any companies that are maybe reducing some of the friction and just the regulation? And I have a client who actually has a reg tech company that monitors regulatory developments in real time and will let people know right away. Is there anything like that in insurance? Because I get the impression that is really dragging the industry down.
Yeah, there are people that have approached it. I don't think there is something that exists right now. I think certain states have friendlier capabilities. I believe the state of Kentucky has a sandbox where you can publish and sell a small amount of products without any legal liability, as long as, so I see states trying to be more friendly. The thing that makes it that you have to file all your things publicly. So if you have a regulatory advantage and you file it, I can then copy that, right? And many people copy Geico's auto filings for their MGAs. And so that public knowledge of the company makes it a little bit less incentivized for software players to come in and impact the space, in my opinion. Vivek, Ben, you guys agree or disagree?
I was going to say, I know one company. It's called Gain Compliance. It's doing some really interesting stuff with state level filings. But I agree that I think the intersection of reg tech and insurance will always be a pain point, not a solution, unfortunately. So I haven't seen too many people building there, but it is. I mean, it's a existential kind of issue for a lot of folks, for sure.
Right. All right. So somewhat similar to this, someone asked what the biggest innovation in insurance has been, for the last number of years. Have there been big innovations in insurance that we don't know about?
I would say, it's interesting. Patrick mentioned something really, interesting with the Guidewire comment. I think there are tons of innovative ideas in insurance. I think there's very few innovations that get adopted. right? And so when I think about like, what do I view as like innovations that have received adoption, you know, your answers are, you know, honestly, it's like Guidewire's business model, like charging millions of dollars for ongoing servicing such that you like can't leave them is probably one of the more interesting like business model innovations we've seen. But I mean, there's no shortage, right? Me, Ben, and Patrick were talking about a company that's doing really creative, you know, insurance underwriting for climate change. There are brilliant people in and around this category that are always thinking about creative ideas. I think the ones that cross the fold of like regulation and then adoption and then implementation are we just haven't seen that many. I think when I think about like true technology innovation that has, you know, those companies that are powered by it that have gone over $15 million of ARRs, these are software companies, not many, right? Particularly that are kind of venture backed. So kind of my answer today is that, yeah, tons of innovation, lots of individual, we'll call them science projects, but very few that are at scale enough to even answer that question honestly. I don't know if folks feel differently.
My answer might be a cop-out answer, and my answer would be the progressive snapshot, the UBI device. And UBI stands for usage-based insurance. It was OBD2 port is the device. And that was launched in 2004, and it allowed you to underwrite based on your driving performance. It took 10 years to develop, which is kind of shocking because I think most startups could do it in like 6 months if they started from where they started. It took 10 months to develop the underwriting tools and guidelines. But the innovation I like from that is that what it really did is it was just an acquisition tool. Any customer that was willing to put a device in their car was automatically a better driver because they were already safer drivers. And that always reminds me that this space is about differentiated acquisition and being able to acquire customers well. And then that also led to usage-based insurance, which has just revolutionized the space on how we quantify risk and continue to quantify it.
I think for my end, I don't know how exactly innovative it is, but I just think like this whole digital MGA onslaught we've seen is like very innovative, right? Like, and not to go into the full economics of it, but basically Lemonade, a lot of these companies we've talked about, they're not full insurance companies, right? They're digitally native MGA carriers, and they don't have to take the full risk on. They have reinsurance capacity on the back end, right? So it's not like they have a giant balance sheet that they have to pay out their claims from. They rely on, you know, reinsurance companies like Munich Re and many others to get their capacity. And so I feel like the entrepreneurs that saw that early in 2014, 2015, and even historically, before that, even like I think Oscar's a full carrier, I think, but yeah, I think they've really taken advantage of that, and yeah.
I would just like the insurance pessimist in me has to speak up here, which is like, you know, Ben, like MGAs have been around from the 60s. We just use computers from now. And Patrick, like, you know, you know better than all of us about, you know, usage-based insurance adoption rates and the ability. Like, I think one of the things that I always get sad about is like, again, there's so many creative ideas. None of them I think have fundamentally changed the insurance experience for folks at scale. So that's where my like super depressing insurance answer comes from. But I am like intellectually interested in like both of those topics.
Hence why I started with the user acquisition rather than the technology, right? Like the differentiated. Yeah. You're a blast to have. Like just.
For the audience, when you say MGA, I think you mean a managing general agent, right?
Yes.
Okay, good. Just make sure we're all on the same page. Here's one. Somebody wants to know if there's an opportunity towards making insurance terms easier to understand for end users. I would buy that.
Can I be the pessimist here? Can I be you?
Go for it.
Do it.
My answer is no. The insurance carriers would love to, but they're bound by regulators on what they can and can't say, whether that's rebating laws or warranties or all these things. They're bound, and I think there's probably UX UI ways to make it better, and I think Lemonade was the best example. They went out as not like a digital tech stack that they evolved to. They went out as like, we can improve how we sell this. But terms, no. I think we'll be bound by what the states require people to say. The contracts, insurance carriers don't defraud you. very often, and when they do, it's usually by accident. They want to stay to their contracts because they need to by law. So I think it's a regulatory thing. I could be wrong, but I think we're in it for a while.
I mean, I think we've mentioned on this before though, like the customer journey now has been so optimized by many of the most successful InsurTech startups that they try to make it as easy to understand as possible, right? We've also seen this with some life insurance products where they just like try to make it plain vanilla as easy as possible. And that customer experience, it's a key differentiator versus, you know, incumbent carriers versus all the startups. So the language itself, I'm totally with Patrick, but I think you can do, I mean, there's been a lot of time and effort being put into just, hey, let's make this easy for a kindergartner to understand and go from there.
Yeah, I'd probably say, like, I think what Ben says really resonates. I think that a lot of people have, you probably can't solve the like legal aspect of what you can and can't say, but you can redefine what a lot of terms mean at the highest level. And like a really good example I think of this is like in the pet insurance world, you know, a lot of pets have kind of, those markets have turned into like, hey, just pay a monthly subscription, right? It actually is an insurance policy, but you've redefined how someone interacts with it completely. So they don't even think about it as like a medical insurance policy for your animal. So I think that there are these like edge arounds you can do to kind of change how consumers kind of view the policy to begin with. But unfortunately, the legal terminology, I think we'll all be Googling for quite a bit more time.
Here's an idea. It looks a little complicated, but they'd like your thoughts on an idea for use a person to guide a homeowner to video a property, and then the guide can in real time, I guess it's not so complicated, can approve the insurance. So you had mentioned earlier that, you know, that there's some of this remote home inspection. Is this a real thing? Is that an idea you would get behind, or has it already been done?
Yeah. Yeah. I mean, that's what this company was doing. As I mentioned, Flywheel. I think there are some other solutions out there as well, but it just makes sense. I think at a very high level, whatever the company is, everybody has a personal device now. I mean, the penetration rate must be in the like 90th percentile, but I think it's utilizing that camera that's pretty powerful to do a lot of different things. There's another company, that's raised a bunch of money. The name's escaping me right now, but
Hover.
Yeah. Cover. And so there's, and this doesn't apply just to the home, by the way. There's companies doing this for, you know, after you get into an accident, you know, you're taking photos and videos of cars. I think Progressive has that type of a solution. So yes, I mean, it's a very viable idea, but you know, I think there are a number of that technology, it can be commoditized fairly quickly. So I think it's sort of the distribution aspect of that business is going to make or break the company.
The only comment I would make onto it is I invested in a company called Hover that did that for the outside of the home, and they do it really effectively, but you have to do it in the time span that fits people's behavior on buying insurance. Like I think the tech exists currently right now that you could do it and scan someone's home, but that wouldn't fit into someone's appetite for purchasing insurance. The NPS score is similar to going to the dentist for purchasing insurance. And so catching people at the point of when they're actually looking for insurance, you have a pretty small window to close someone. And so it's being able to do it accurately in that time span, I think is the difficult aspect of it.
Yeah, I think that this is there's a roadblock on both sides, right? On the front end, if you're going to acquire a new customer, you need to be able to do this incredibly fast and accurately, which is, you know, seems to be a challenge. On the back end, on the claim side, the challenge is a lot of the damages that can happen inside of a home are actually incredibly hard to detect by camera, often the most expensive ones. So like, you know, you have flood damage or you've got water damage in your walls. It's actually really hard on a relative basis to detect that on your camera. And the ROI is so significant that it still makes sense to send a human there. So the challenge is on one end, it's hard because you need to be accurate and fast. On the other end, it's difficult because it actually makes monetary sense for a carrier to send someone out there. So you need to kind of thread the needle on, you know, on the back end, triaging the claims you can detect, and on the front end, doing so quickly and accurately. So tough problem, but if you build it, I'm sure it's super valuable.
Yeah, so here's a question that I wish I had asked. It's a question about driver assistance, automated driver assistance, and telematics for insurance, particularly to reduce the risk. That's really two questions, but maybe break that down. So first of all, thoughts on driver-assisted automobiles. And is that happening? Is there an opportunity there? Is it worth it? Would insurance companies be interested in that?
To me, it's a lot more about the insurance companies' access to have to be able to use the data. As I mentioned, the OBD2 port, which I think was like 1993, was introduced, was to give insurance carriers access to that, and it has 13 pins and it covers things like G-forces, direction, location, speed, and braking events. I don't see Ford opening up whether you're wearing a seatbelt or not. Right, that was one thing that was purposely left out of that iteration. I don't see legislators coming together saying, well, insurance companies need access to this, this, and this. Now, if you're Tesla and you operate your own insurance company, you might be able to file on that. But I think we need to evolve a lot more from a regulatory standpoint. That's why you're going to see a lot more people use the devices that's on your phone, because they can get similar access. But I think right now what we're seeing is just driver assistance. You get discounts because I think we have models on if you have driver assistance, what does it do to your risk profile? But I don't see insurance companies being able to stronghold the industry and get access to a lot of the data that they want.
Yeah, we just invested in a company called HDVI, which is focused on commercial auto and specifically trucking and fleets of trucks. And part of their solution is also to incorporate telematics devices and ADAS solutions in order to drive down claims. And commercial auto is like one of the worst lines of business you can be in, with like for every dollar or $100 they take in, they pay out 115. So anything, so telematics is definitely a solution to try to drive those claims down. And as Patrick mentioned, I mean, Elon Musk on the Q2 earnings call mentioned how he wants to recruit more actuaries for Tesla insurance. So it's and I think that's the same line of thinking, right? They're going to have a lot of data from Tesla. Already has that data from all the sensors on a Tesla. So can you more properly price the risk of the Tesla driver? So yeah.
And for the audience, when we talk about telematics, we're really talking about programs that, well, a couple things that monitor the driver's conduct, right? But also give them options, to determine how they want to act, or how they want their driving patterns to be, and maybe get a better insurance price. And I guess what you're saying, I imagine the privacy considerations are just enormous. And what you're saying is that there are some hurdles there, right? Because of industry. Okay, let's see. So here's a question about what do you see happening over the next 5, 10, 20 years in insurance tech? Any predictions?
If you can answer that, you can make a lot of money in VC.
Yeah, I think there are things that very broadly, I think my guess is we'd all agree on, right? You're going to have more data, more access to data. You're going to be able to underwrite on it. You're going to have new groups of consumers that aren't going to purchase insurance at the point in time or in the way folks have done in the past. And so I think insurance companies will see like a rebranding of existing insurance products marketed to different groups. So we'll see kind of shifts like that. But I think beyond that, it's a multi-billion-dollar question on like when they do these things and how they do it and how those preferences shift. So we'll leave it to Ben to give us the answer here.
But that's really not such a bad question, because you guys as VCs, you're investing for 10 years out, right? Because your exits are going to be a while out. So you really are looking ahead quite a ways when you make your investments.
So but I think that go ahead,
Vivek.
I was going to say the answer is yes and no, right? Like, and I view like autonomous cars as a great example of one of these instances. Venture capitalists are looking for businesses that reach scale in 10 years, right? And I think there's a conflation between industries that emerge 10 years from now. Like, I think if you were to ask me like autonomous car insurance, I think it'll be huge in 30. But if the lifetime of a fund is 5, 8, or 9 years, your ability to reach enough critical scale and revenues in the next 5 or 6 years is going to be mitigated if you don't believe autonomous cars will reach, critical mass in 20 or 30 years. So I think the answer is yes. I think VCs do think a lot about the future, but they're actually, I think, at least maybe I should just speak for myself. I think we're thinking about what are technologies that have critical needs today, maybe a little bit tomorrow, but can get to tens, if not hundreds of millions of dollars of revenue, in the 5 to 10 year period, as opposed to the kind of what's relevant will begin becoming relevant in year 10.
Yeah, I think that's fair. Although we do now have a deep tech fund, which is like we're investing pre-commercialization, so it's like even further out, right? But those are definitely more like science fiction type of stuff. I think in terms of what I see in the next few years, one thing is, or the like 5 to 10 years. I mean, at a very high level, it's like Tesla is a good example. We were just talking about it. They sort of have this data advantage, right? In thought, that's what everybody's thinking, right? Like they have a data advantage, so they're going to be able to better price their cars in terms of from an underwriting standpoint. And so I think a lot of insurers have been talking about this for a long time, but it's like, what happens if some of these other platforms that have a data advantage launch their own insurance products? So talking about big like if Amazon wanted to get into this space or what have you, I mean, probably not more like on the social media side, but I think these really big players that have highly engaged user bases and have some level of data advantage, I think if they start to enter the market and there's this continued fragmentation of, the distribution of insurance. I think insurance is going to be embedded in a lot of different platforms and they'll at least, if Amazon doesn't want to do their own insurance, maybe they're just going to tack on somebody else's product. And, a company in India is doing this right now called Acco. And now they're working with Amazon India to tack on, a device warranty product and some other things, a car insurance product. So I think that's going to start to proliferate, and that's just one maybe trend to look after. And that's like 5-10 years out in my opinion.
Patrick, you got any views on long-term trends?
Yeah, my two colleagues said it incredibly well. I think that the only thing that I might put in there that we didn't talk about is just I think capital markets may get more involved in the evolution of pricing risk. I think that there's always been a desire to have more capital markets, public markets involved in the insurance industry. Ben works for a reinsurer, which is, like an incredible model, and they're getting more, and reinsurers are getting more and more involved in the tech stack of insurance themselves. But I think as we evolve into pricing cyber risk, I think capital markets might want to be involved if they're that way they can be more allocated in the insurance values chain.
Okay. I got a question. Since we've gone through most of the audience questions, how important is it that you find when you invest in an insurance tech company that you have a founder that's got domain expertise? Again, you got me thinking about this regulatory aspect. I mean, you're going to find good technicians, and people always say that, gee, you need a good technical co-founder. Seems to me in a space like this, you really need someone who really understands this business and the regulatory side. That'd be my guess. Am I right about that?
I can start, or yeah. So from my perspective, at least from my experience with our portfolio, I mean, if you don't have an insurance background, they're going to be one of your early hires for sure. So I think a lot of these companies start from a technical perspective. Like we've mentioned Guidewire on here before. A lot of these startups don't use Guidewire. They build their own sort of pipes, their insurance pipes and policy admin systems from scratch, and they're sort of modifying a third party. So it starts pretty technical, but early on, I mean, you need to sort of learn it yourself. I think a lot of our really top the founders of the unicorns we're invested in, they didn't necessarily come from insurance, but their learning curve, they were able to shorten that pretty quickly. And they were real sponges in learning the industry. But then they also hired some experts early on. So that would be my answer.
All right, well, we are at 1:30. Before we leave, I'd like to ask each of you, how does someone get a hold of you if they want to follow up with you? Ben, we ended with you. Why don't we start with you?
Sure. Yeah. So I'm easy. Ben at munichre.com. That's my email. Come straight to me. And yeah, excited to meet many of you. Or if you have questions and you're just in the insurance industry and want to chat, I'm always happy to chat with you. So,
Vivek?
Yeah, I think email is probably the best way. So it's vivek@commerce.vc. You're welcome to kind of add me and message me on LinkedIn if that's easier for you as well. But, same as Ben, always happy to chat with folks who are curious about the space or kind of live and breathe it, because that's always fun too.
Patrick?
Patrick at mgv.vc.
Okay, so with that, I am going to turn it back to Rob Lau. I want to thank you panelists for being there. I learned an awful lot in this panel. I will tell you that. I got the best seat in the house. So thank you for that. Thank you attendees for sticking with us, and thank you, Rob, for hosting this event.
That was an awesome panel discussion. A lot of good information. Thank you, Patrick. Thank you, Ben. Thank you, Vivek, for spending time with us today and sharing your insights. Roger, thanks for moderating. Audience members, thanks for tuning in and asking great questions. See you next time.
Great. Thank you.